Reserve Bank Governor Philip Lowe was out again this week, confirming that he, like Jay Powell at the Federal Reserve, was not entertaining any ideas of negative interest rates. For more on how the economy is handling the slow comeback and how the property market is weathering a new bout of pessimism, Leo Shanahan spoke with Westpac senior economist Matt Hassan.
Matt Hassan, thanks so much for joining us. I wanted to start off asking you about the regulators panel yesterday, including the Reserve Bank Governor. He's saying that going to negative interest rates would basically do more harm than good. Your thoughts on that and the implications for the housing market?
Look, I think that's quite notable. There's a bit of market speculation at the moment about whether the RBA will join, in particular the RBNZ, which looks to have shifted its view on negative rates. The Governor was pretty explicit yesterday, saying he's still not a fan of negative interest rate policy. So that's been put off the agenda. The market may still speculate around whether that view changes over time. For the housing market, it's not really a big deal. I think where that sort of policy might come to play is obviously around the yield curve for rates locally and the currency. And I think that's where markets are most interested when there's been a bit of a reaction to the RBNZ's change of tone there. But I think the RBA is clearly still hasn't changed the RBA government hasn't changed his thinking around negative rates at all.
I wanted to ask you as well about the commercial property market. The Australian's headline this morning was Tower Infernos of cash. Almost $50 billion could be wiped from the value of commercial property in Australia, according to that report. Your thoughts on where the commercial property market is in the COVID era?
Well, look, it is a very tricky situation. As we know, property markets at the moment are not really at the centre of the coronavirus recession, but there are a huge sort of collateral damage to some of the changes that are going on. And in many cases, there are some structural shifts that may occur over the medium term. We all know about the move to remote working as part of the coronavirus has been massive. And with health restrictions easing, there's question marks around the longer term. We're not going to go straight back to chock-full CBDs and public transport at full capacity, and offices are going to see long-term changes and medium-term changes as well. Likewise, in sectors like retail, there's going to be major overhauls, a large shock near term, and potentially some structural changes over the medium term. And so for the commercial property market, there's a big question mark. Right now, obviously we're still in the midst of the disruption. The large economic shock is still playing through, and these structural adjustments are unclear. Will we actually see a shift towards away from things like the CBD, or is that just a 1 or 2 year phenomenon as we adjust to a world of COVID-19, and does it sort of rebalance over the medium term, or are we going to see more fundamental shocks? I think with that uncertainty overhanging the market, very thin market conditions across all property markets, you're always prone to a sudden price adjustment. So it's understandable that the sector's fairly concerned around where prices may land and how all these uncertainties may play out. I would couch that that uncertainty runs both ways. If we were to suddenly assume that half of the CBD workforce would be working remotely rather than on site, that could prove to be a major miscalculation if the coronavirus becomes a side issue in 2 or 3 years' time. So I think it's a highly uncertain environment, and prices, as always, are going to be all over the shop.
Well, what about the impact on rents so far, Matt? It's been pretty dramatic, especially because of the impact on immigration levels.
That's right. I think what we're seeing from our own survey of consumers, those who are renting, around about 15 to 20% of those consumers have already seen a temporary reduction in their rents. Most of the reductions are in the sort of 0 to 25% range, and that's existing rental agreements, so rather than newly negotiated rents. So those new rents are probably where, at the forefront of this adjustment, they'll be seeing likely larger declines. And also, given that, as you say, the migration flows have more or less stopped, and there's a bit of a vacuum in parts of the market as a result. That said, what we're seeing from some of the asking rent measures around is that the big changes seem to be happening in pockets. So whether it's the inner areas of Sydney or particularly sort of student-driven areas of the market have seen more material rises in vacancy rates, for example, and more pressure on rents, whereas it's a bit more uneven across the rest of the market. I think on balance, the extent of rent reductions and temporary rent relief is probably less than we would have expected. So our survey was run in May. As I said, we found about 1 in 5 renters had a temporary adjustment. If you average that across the whole rental book, it's probably about a 5% reduction in rents across the board. Not quite the more eye-popping shifts that we're seeing in asking rents at the moment.
Okay, Matt Hassan, thanks so much for joining us.